Hello, everybody. Welcome back to my channel. And today I'm continuing my series on debunking velocity banking and their major concepts. We're continuing with defining several basic terms in finance and personal finance, as I found that many of the velocity banking videos either don't properly define these terms or they misuse the terms. So before we can have a meaningful discussion, we need to all agree on the terms that we're using. Uh, Please like, subscribe, and comment and help my channel grow. Today we're going to look at loans. Last week we looked at cash flow. There's going to be a link in the description for my previous videos in this series. Today we're going to cover loans. Basically, what is a loan? What are different categories of loans? I know it seems kind of simple, but we need to do this in order to have all of our definitions straight and have meaningful conversations. So number one, what is a loan? I know this might be obvious, but let's take a look. In basic terms, situation where you borrow money that you then have to pay back later. So I don't have money today, or I do have money, but I need more money. I borrow money, I have to pay it back later. Lenders loan people money, and borrowers receive the money or borrow the money. All right, so somebody makes a loan to you. That could be a friend, family member, that could be a bank, it could be a credit union, and so on and so forth. All right, so many different people could loan you the money, many different people can borrow the money. Who can borrow money? Individuals, businesses, and so forth. All right, when we borrow money, lenders charge interest. Okay, so if I borrow $1,000 from a bank, they're going to give me $1,000, and in the future, I'm going to pay them back what I borrowed, which is $1,000 plus interest. Interest is how lenders make money on lending money. Okay, so they have to get a return. If they just loan me $1,000 and I just paid them $1,000 back in the future with no interest, they wouldn't loan me the money, right? If there's zero return, they would take their $1,000 and invest it in some other avenue or some other vehicle where they could get a return. So interest is basically what we have to pay in order to borrow money. Interest is always calculated based on the outstanding principal or the outstanding balance of your loan. Okay, so if I borrow $1,000 today and I'm paying back monthly, each component of my payment is going to have payment toward the principal or what I originally borrowed and a component for interest. All right, so if I borrow $1,000 and I pay back $100 per month, part of that $100 is going to go to paying the balance on the loan, 1,000. Part of it is going to go to interest. Now, as I pay the loan down and the principal balance goes down, so will the interest. So let's say the first month I make a payment and it's $100. Let's say 75 goes to the principal and 25 goes to interest. So the bank makes $25. Um, my outstanding balance is now 925, right? Because out of the 100, I paid down 75 on the principal. My outstanding balance is now $925. So when I make that next payment of $100 the next month, more of that is going to go toward the principal and less toward interest. Okay, because my interest of $25 for the first month was on the balance of 1,000. Now that my balance is 925, I'm going to pay less than $25 in interest on my next payment. So my interest is always calculated based on my outstanding principal or my outstanding balance. All right, loans have several aspects that come with them, and we have to actually understand or actually define them so that we're conscious and aware of these aspects in our conversations. All right, so aspects of a loan: principal amount, that's the amount that we borrow. If I go to the bank and I borrow $1,000, or if I get a loan for a house for $200,000, the amount that I'm initially borrowing is the principal amount. If I'm borrowing money on a credit card, so there are different avenues, I'll discuss them in a few minutes. Again, if I swipe and I charge $100, that's my principal amount at that time. Annual interest rate, so what is the interest rate that I'm going to be charged per year for the money that I'm borrowing? Normally, they're expressed as an APR and or an APY. APY is different than APR because there can be additional fees. So when I borrow money, if the interest rate is 5%, if there's additional fees on there, that'll actually increase the interest rate that I'm paying a little bit, which becomes the APY. Why do we have APY? So that when I'm comparing rates on loans, credit cards, etc., from different companies, I can look at the APY for each loan and make an apples to apples comparison. Annual percentage rate is APR, annual percentage yield is the APY. All right, next, payment period. How often am I paying back? Right? For most loans, mortgages, um, credit cards, student loans, business loans, etc., we're paying monthly, but there are some loans where I can pay quarterly. There are some loans where I can pay yearly. Most of the time, we're paying off our loans monthly. All right, compounding period. Compounding period has to do with a concept I'm going to talk about in a few minutes, or actually in another video coming up next. But basically, when is interest added to my account? This is actually very, very important. Um, the period in which the interest is added can cause me to pay more and more interest. So again, for example, if I borrow money and I'm expected to pay it over a year, and I'm paying over each month, if the interest is applied each month, uh, that's different than the interest being applied every week or every day. So the more frequently that interest is applied, the more interest I'm actually going to end up paying. So again, most loans, they're going to apply the interest at the end of the month, and that's going to coincide with the day that I'm going to pay. So that interest actually doesn't roll over onto my next month's balance. That's usually true for home loans, student loans, business loans. For credit cards, that works a lot differently. And, again, we'll discuss it going forward. Length of time for the loan. Is it a 1 month loan? Is it a 1 year loan? 10 years, 20, 30 years, 40 years? That's what you're going to have in terms of longer term loans for cars, homes, student loans, business loans. In terms of credit cards, lines of credit, those are revolving loans. That's going to be a little bit different. My monthly payment amount. How much am I paying each month? Of course, this is very important because I have some finite amount of income, right? I'm making 2,000 a month or 3,000 a month. I need to know how much I'm required to pay on all my bills, my loans, my credit cards, etc. So I know how much income and how much and expenses I have each month. So these are all the aspects of a loan. How much did I borrow? How much interest rate am I paying per year? How often am I paying? How often is the company going to add interest on top of my balance to the account? Length of time for the loan, and how much am I paying every month or every quarter, every year? All right, different types of loans. So basically, you have two different types of loans, which are revolving loans and installment loans. So revolving loans are basically credit cards, lines of credit, home equity line of credit, which is based on the equity in your home. They're called revolving because you're expected to basically use the credit and then pay it back monthly and then use it again and so on and so forth. Anybody who has a credit card knows this, right? I go to the grocery store, I charge $50 in groceries. I go to the gas station, I charge, $40 in gas. Next month, I'm going to pay my credit card bill, and then I'm going to use my credit card some more and buy other groceries or pay other bills and so on and so forth. This is revolving because I'm constantly charging on my credit card and paying it month by month. Installment loans are more long-term loans. Okay, so I want to buy a house. I want to get a loan to pay for the house. I'm going to pay that mortgage over 10, 15, 20, 30 years. Or I get a student loan or a business loan. I'm going to basically get one big chunk of money at one point in time. I'm going to pay that off over several years. So that's what we call an installment loan. So again, you can notice like revolving lines of credit, credit cards, etc., have a different purpose than loans that are called installment loans, which are long-term for housing, education, cars, and businesses. The revolving loans, credit cards are meant for short-term, everyday small expenses. The bigger loans paid over many years are for bigger expenses. So here we have credit cards, lines of credit, home equity line of credit, which is called a HELOC. Those are revolving lines, business loans, student loans, auto loans, home loans, which we call mortgages. Those are all installment loans. Installments meaning we're going to pay the loans back in installments, monthly installments, month after month, year after year, until that loan is paid off. All right, so this is kind of a short video Just going over the basics. When we pay our loans, the revolving loans again are like credit cards, lines of credit. We're constantly paying them and using the credit line to charge more to the account. So the balance fluctuates a lot month by month, day by day, week by week, and month by month. With the installment loans, the balance goes down gradually over time as you make each payment month by month. The loans will generally go down in terms of balance, and I won't be borrowing more. So when I get a mortgage, I generally will be paying that loan balance off month by month, year by year, and I'm generally not going to add to the mortgage balance. It's just going to consistently decrease. Same with the student loan, business loan, whereas the revolving loans, the balance is fluctuating month by month as I make new charges and make payments. All right, so credit cards and lines of credit again are revolving loans. I can easily charge and borrow more every day. Again, as we saw in the cash flow discussion, borrowing money on a credit card does not increase my cash flow. Cash flow is income minus expenses. If I charge my groceries or my gas or my telephone bill, I'm not actually increasing my cash flow. I'm just deferring that expense at a later date. I'm actually incurring a liability that I actually have to pay later. Also, when I pay a credit card, I do not increase my cash flow. What I do is I decrease my outstanding balance on the credit card, which means I have more available credit and I can charge, more groceries and more gas, but I have not increased my cash flow. Just very important point there. Principal amount on the lines of credit, credit cards, etc., will change daily. Minimum payments vary according to the outstanding balance. Again, this is how they calculate your payments with credit cards and lines of credit. Is they'll actually tell you your minimum payment that you have to make each month is some percentage of the outstanding balance. Okay, this is very different than installment loans. So for credit cards, lines of credit, they'll say your minimum payment is some percentage of your outstanding balance, which means your payment is actually going to fluctuate month by month. So if I'm in January and my credit card balance is $100, a lot of places, a lot of companies or banks will charge you 2% of your outstanding balance as a minimum payment. So my payment might be $2 that month. If I make a bunch of transactions and charge up a bunch of money, maybe my credit card bill the next month is $1,000. 2% of that will be $20. So the credit card company in January told me, well, your minimum payment is 2% of your outstanding balance. Your outstanding balance is $100. Therefore, your payment is $2. In February, they say, whoa, your balance is 1,000. 2% of 1,000 is $20. Now, I don't recommend paying the minimum balance because that's just going to cause me to prolong the time I'm borrowing the money from the credit card and pay really high interest rates. But that's different than installment loans. So let's take a look at those. Installment loans generally have fixed interest rates. Home loans, auto loans, student loans, business loans. We pay it over a fixed period of time, 1, 5, 10, 20, 30 years. The payments are actually going to be consistent, that you're going to pay the same amount. And that's a critical difference, right? With a credit card loan, you're paying a percentage of your outstanding balance. When we do the calculations for paying a long-term installment loan, each payment is designed to be exactly the same as the other. Okay, so if I buy a car and I'm going to pay the loan over 4 years, my payment is going to be consistent. It's going to be $300 per month for the entire 4 years, for example. Or if I buy a home and I borrow $200,000 to buy a home and pay it off over 30 years, let's say my payment is $1,000 a month. It's going to be $1,000 each month for the entire 30 years. So that payment is not going to change. Whereas with the revolving loans, your monthly payment is going to change, or the minimum payment is going to change based on the outstanding balance. Now, again, I don't recommend carrying a balance. I recommend paying off your entire credit card or line of credit loan every month so that you're not incurring interest. But if you can't do that and you are carrying a balance, they are going to calculate your minimum payment as a percentage of the outstanding balance. Now, that doesn't mean you have to pay the minimum. You could always pay more than the minimum, so you pay it down faster. But again, for the installment loans, home loans, etc., you're going to pay the same fixed amount over the entire length of the loan. All right, and each payment consists partially of interest and partially of principal. Uh, Again, if you borrow $200,000 to buy a home and your payments are $1,000 a month, uh, the first month you're going to have a lot of interest and small amount of principal. But at that point, your interest is going to be the highest that it will ever be. After you make that payment, your principal will get lower. Let's say it goes down from 200,000 to 199,000. The interest that you pay the next month is going to be a little lower because it's been calculated based on the fact that you now only owe 199,000. So as time goes on, the amount of your payment, your $1,000 payment that goes to interest is going to decrease. The amount of your principal is going to increase. The amount of your payment that goes toward paying off the principal of the loan is going to increase. And I'll show an Excel example in a future episode. This is just kind of a preview. We're just talking high level concepts. I will actually show concrete numbers and an Excel file, and I'll show you how this all works in a future episode. All right, payments are fixed over the loan since the principal amount doesn't change. And what I mean by that is when you have like a home loan or an auto loan, if I buy a car, I borrow 20,000 today. If I buy a home, I borrow 200,000. I'm paying that down over time, so the principal amount actually decreases, but my borrowing amount doesn't change. Like I'm not going to, once I borrow the money for the house, I'm not going to borrow more money and more money. It's not revolving. I borrow it, buy the house, and then I pay it off over time. If I buy a car and I borrow 20,000, I'm not going to be adding to that car loan, right? Like after I pay it for a year, maybe I only owe 15,000 after 1 year. I'm not going to re-borrow and charge more onto that account like I would a credit card. All right. So another major difference between revolving and installment loans. All right. So that's about it for loans. But I did have to do a video on this just because there's a lot of people out there in velocity banking that want to kind of conflate or obfuscate, oh, a revolving loan and an installment loan. Get a loan on a personal line of credit, borrow on a credit card. Don't borrow on a long-term loan for a house or a car. That's bad. Buy a car and use a credit card and pay 18%. And it's just absolutely nonsense. And they conflate these ideas and they go, well, like a long-term loan is really bad. And a credit card is a line of credit is not a loan, it's a line of credit. And a line of credit is better than a loan. Actually, either way, you're borrowing money. And anytime you're borrowing money, you're going to pay interest and you're going to pay it back. Revolving loans work a little bit differently than installment loans, but either way, a loan is a loan. And I get frustrated watching these videos where they go, don't get a loan from a bank, get a line of credit. A line of credit is not a loan. It's much different. You're still borrowing money. It's still debt. It's still a loan. All right. So main points, loans involve lending and borrowing money. Overall, we could call it's debt. Anytime you borrow money, it's debt, regardless of whether it's a credit card, line of credit, or a long-term installment loan. It's just that those have different purposes. Loans involve paying back both principal or the amount that you borrowed, as well as the interest. Interest rate and time period are important. Again, you're going to hear people of the velocity banking world go, interest rate doesn't matter. This magical technique called velocity banking makes interest rate irrelevant. As we're going to see, this is actually complete nonsense. Nobody goes to a credit card or to a bank and says, hey, I want a loan for a house. Your rate is 5%. No problem. Charge me 10%. It doesn't matter. I'm doing velocity banking. Interest rates are irrelevant to me. That's just complete nonsense, and I'm going to debunk that in detail in a future video. But interest rate and time period are definitely important. Loans come in many forms, including mortgages, installment loans, credit cards, lines of credit. All right, so that's it for today. Future video, we're going to talk about interest and interest calculations, the way interest works. And in future videos, again, I'll go into detail on some examples. I'll use some Excel files. And then eventually we will get to actually videos of here's what velocity banking people say, and I will debunk their main concepts and their main ideas, literally line by line and idea by idea. So thank you very much. I hope to have you watch my future videos. Please like, comment, and subscribe. and I will see you soon.